Hey, welcome back, Accounting 604. This is now video number 3 in Module 6 as we look at how to analyze and interpret assets on the balance sheet. And in this particular deck, you can see we are looking at analyzing inventories and accounts payable. This, of course, conceptually, two sides of the same coin. How are we managing the inventories that we are acquiring to generate revenue, and when are we paying for those inventories that we typically have purchased on credit? All right, and as you can see on this very first slide, our analysis of the gross profit margin. Gross profit margin, of course, defined as gross profit divided by sales. And so what is the gross dollar of profit that is derived from every dollar of sales? And you can see a couple of things here for our example company, Home Depot. In this particular slide, that orange vendor of home improvement stuff, right? From 2020 to 2022, you can see that on the somewhat favorable side, at least initially, it looks like the level of gross profit, which we define as, again, as simply net sales minus cost of goods sold, has increased every single year, right? I mean, you look at that first underscored subtotal from 44.8 to 50.8 to 52.778. Gross profit is increasing every year, but really the issue here is, upon deeper analysis, the level of net sales is increasing even faster, and therefore, when you take your gross profit margin, gross profit divided by sales, you can see that the gross profit margin is actually declining each year from 34% in 2020 to 33.6 in 2021, and then dropping further from 33 to 33.5 in 2022. Now, there are notes in the financial statement. You can see it reprinted there. At least the excerpt. Home Depot attributes this slight decrease in GPM to several different causes, right? Primarily driven by higher product and transportation costs, pressure from shrink during the second half of the year, and investments in our supply chain network offset by the benefit of higher retail prices along with more favorable product mix. By the way, what is retail shrink? Some of you may be somewhat unfamiliar with that term. Of course, those of you who have worked in retail at any point in your history, you're very familiar with what the term shrink means. It means that, doesn't mean that the shoes themselves are shrinking in size. It means that suddenly there's inventory missing from the shelf, and what is this? All of the employees have brand new pairs of Air Jordans. Yes, it typically refers to customer or employee theft. And three of the companies in the retail industry who have the lowest level of shrink, one of them is, of course, Costco. For those of you familiar with Costco, realize you cannot get in or get out without being checked. In addition to that, a very high level of employee engagement means that they have managed to drop their shrink or inventory shrink down to an exponentially low level compared to the general level in the retail business. The retail industry typically suffers about a little over a 1% reduction in inventory due to shrink. Costco historically is under 0.2% historically. Target has also been able to greatly reduce their amount of shrink as well. And so you can see here, there are several reasons why Home Depot on this slide says that they're reporting a lower gross profit margin. And interestingly, one of them called out is shrink, which is something that needs to be actively and in some cases aggressively managed. All right, so back to our slide. You can see some of the reasons why GPM might be negatively affected. This list on this slide, of course, is not intended to be comprehensive. These are just some of the things that can make a huge dent in your GPM. Let's go over some of them. Changes in your product mix toward lower margin products. New products introduced at low prices to gain market share. Increases in production costs. Decreases in production volume. Increases in some part of your supply chain. More incentives like sales discounts or sales return policies. inventory obsolescence and or overstocking, which of course you can sort of substitute that bullet point as inventory mismanagement. High level of warranty costs, general decline in economic activity, also known as recession, new competitors in the market, regulations that inhibit sales or add fees or taxes. All of these are reasons that your GPM might be shrinking. Some of these you will note are things that, well, at first blush may appear to be completely out of your control because they're part of the external environment. Others are not necessarily negatives to begin with, right? The fact that you have strategically chosen to change your product mix and focus more on lower margin products, or introduce new products at low prices in order to strategically gain market share. Those are not necessarily negatives, but they will affect your gross profit margin. Now, past that, then, there are a couple of figures on this slide. You can see here a couple of ratios that we calculate in order to better analyze and understand what is going on with inventory management. The first of them is inventory turnover, which as you can see here is calculated as the cost of goods sold for the period divided by average inventory, which of course is defined as beginning inventory level plus ending inventory level divided by 2 to get an average, right? Once you have calculated the inventory turnover, which measures the number of times during the period the company sells its inventory or turns it over, you are then able to use that as the denominator, divide into 365 to do what? To calculate days inventory outstanding, or the average number of days required to sell your inventory. Okay, so you're essentially taking your inventory turnover and turning it into a calendar approximation, right? Now, how do we analyze these things? When we talk about, for instance, Home Depot, we do the rough calculation, and we can see here inventory turnover is approximately 4.5 times, 4.456 to be precise, which yields in the later calculation a days inventory outstanding estimate of about 82 days. What does that mean? You can see there, Home Depot sold or turned over its entire inventory about 4.5 times during 2022, and it on average took them about 82 days to sell its inventory. Now, what does that mean? Well, you can see the little tiny chart reproduced from the textbook there in the lower right-hand corner, and you can see the average days inventory outstanding, which varies significantly based upon the type of industry we're talking about. And you can see there consumer staples typically around 60 days, household durables more around 100, and so you sort of see, what you would need to really do to better understand what Home Depot is doing is compare it to its peers, right? Because as you might guess, taking textiles, apparel, and luxury goods way out at 130 days is not applicable to Home Depot. And so we can sort of see a little better insight as we look at some of the possibly comparable categories to get an idea what's going on with Home Depot's inventory management. Now, the reason why we analyze days inventory outstanding, there's just a couple of primary reasons that jump out. You see them here on this slide. One is inventory quality, and the other is asset utilization. What do we mean when we say that DIO, or days inventory outstanding, helps us to better understand inventory quality? Well, what we mean by that is not necessarily, is this screwdriver a better screwdriver that you can get at Lowe's? No, what we're saying is the product mix that Home Depot is offering can include higher and lower margin inventories. And so what is the mix that that management has chosen to bring to market? What are, second bullet point, what are the promotional policies that the company is using or has put in place to try and attract customers and keep them loyal with repeated purchases? Are there improvements in manufacturing efficiency, perhaps lower investments in direct materials and work in process inventories? Is there better overall inventory management efficiency that can be put in place to improve the quality of the inventory and make it more attractive to turn around quicker and more frequently? Now, when we talk about asset utilization, what we're talking about really is, can a company optimize its level of inventory with things like improved manufacturing processes that avoids or eliminates the buildup of work in process and more quickly gets it to be inventory available for sale? Or can it move towards just-in-time deliveries of raw materials to reduce the overall level of raw materials and those associated holding costs, right? There are just several different things that can be done in each of these, which are directly under managerial control. And that's really the point, is days inventory outstanding does reveal possible managerial decision making that can be put in place to optimize the efficiency and the usefulness and attractiveness of inventory. Turning our attention from inventory management then to accounts payable management, we can look at two ratios here. You see it here. First, the accounts payable turnover, or the number of payment cycles per period regarding paying for your cost of goods sold. You see there, cost of goods sold divided by your average accounts payable, which of course defined as beginning and ending divided by 2. Once you've calculated the number of payment cycles, or your accounts payable turnover, you can then divide 365 into that, which then provides what? The average length of time a company takes to pay its suppliers, or days payable outstanding. What is important about DPO, right? DPO, the longer you can take to pay your payables, the longer you have your available cash to better manage your other cash needs. And so you can see here in Home Depot's case, accounts payable turnover calculated about 8.4 times, which yields a days payable outstanding about 43 days, which is a little longer, slightly, than the typical 30-day payment term that most vendors will provide, which means that Home Depot has gotten fairly good at slightly delaying its suppliers, allowing the Home Depot, the purchasing company, to increase its level of available cash. And so the point here is, are you able to lean on your vendors' patience, leniency, and grace without souring your relationships with them, right? So all of this is part of the cash conversion cycle illustrated here on this slide. And you can see there in the beige rectangle at the top, your aim is to try to minimize the time it takes to complete the cycle, of which you see these three components, which of course we talked about several decks ago in another module, right? So you have the days your inventory is outstanding, which you just discussed, the days the sales are outstanding, which is the accounts receivable function, and finally days payable outstanding, which we just spoke about. Now, every time a company completes one full cash conversion cycle, it is purchased inventory, sold inventory, realized the sales and gross profit, and then paid the accounts payable, and then collecting the accounts receivable. And so over the past 3 years, you can see here what has been going on with Home Depot. In 2020, 2021, and 2022, you can see there the cash conversion cycle has actually been getting longer, from 31.6 days to 32.5 days to 46.3. The cash conversion cycle is deteriorating, not improving. And if we look for a source, we can kind of see right there what's going on. Generally, what's happening is, over time, the days inventory outstanding number, the one at the top, that's the one that has been increasing to a degree that is really beginning to affect the cash conversion cycle. Now, interestingly, the years prior, you can see there in this long blue line from 2013 all the way to 22, going all the way to 2020, Home Depot had actually done a fairly good job of reducing over time its days inventory outstanding, and then since 2020, it has jumped back up again, right? And so part of the question becomes, coming out of the pandemic, what can Home Depot do to better manage its quality of inventory and its efficiency? Some insights then as we conclude this deck. Your gross profit margin can signal some strategic trade-offs. It's not always a bad thing. You always have to pair your margin analysis with analysis of management strategy. As we've noted, not every one of the factors that can erode your gross profit margin, at least temporarily, are all negatives. They could be strategic moves for the sake of the long term. In addition, inventory efficiency drives your working capital and cash. As we have seen, even small operational improvements in inventory management can unlock very significant gains in your free cash flow. And finally, your cash conversion cycle, which of course is made up of these three important components, could really be a competitive lever, could be a source of durable, sustainable competitive advantage, and as such should be a strategic KPI that you follow. For those of you unfamiliar with the acronym, KPI is a key performance indicator, one of the core numbers you should be measuring to try to really understand how well is the company performing and can it improve that KPI. Well, I hope this is helpful. Again, these are some of the deeper ways we can analyze and understand the implications over time of inventory management, as well as the conversion of cash throughout the cash conversion cycle, and what are some of the managerial things and managerial ways strategically that we can improve the performance of the organization. Hope that's helpful. We'll see you in the next video.